Welcome to the Lowenstein Sandler podcast series. I'm Kevin Iredell, Chief Marketing Officer at Lowenstein Sandler. Before we begin, please take a moment to subscribe to our podcast series at lowenstein.com/podcasts or find us on Amazon Music, Apple Podcasts, Audible, iHeartRadio, Spotify, SoundCloud, or YouTube. Now let's take a listen.
Welcome to Don't Take No for an Answer. I'm your host, Lynda Bennett, Chair of the Insurance Recovery Practice here at Lowenstein Sandler. And today I am very pleased to welcome back Rob Crocitto, President of ARC Excess and Surplus, and Lynn Mirabella, who's a Senior Broker and Partner at ARC Excess and Surplus. Thanks for joining me today.
Hey, Lynda, it's nice to be back.
Thank you for having us.
Pleasure. So today I had to bring you two experts on to talk about what's going on in the D&O market. As we know, the last 4 years has been a roller coaster ride for policyholders. Back during COVID, it was a very hard and difficult market. People had to gulp when they were going into their renewal process. But it seems as though conditions have changed, and would love to hear from you two who are on the front lines of placing coverage on behalf of policyholders, exactly what's going on. So why don't we jump right in? And as we begin 2024 in earnest, why don't you give me some insights on how the renewal season is shaping up for policyholders in the D&O market?
I can start with the private company side. In general, premiums, retentions, and coverage is pretty flat. In pricing, we're definitely seeing still reductions in the space. We're definitely have more flexibility to get reductions in retentions, which has been helpful. And on the coverage side, I mean, as brokers, our main focus is always to improve coverage. So I think for private companies, they're still in a pretty good spot. It's still a soft market.
We're able to negotiate terms and conditions a bit more?
Yes, that's definitely our focus. I mean, we don't want to, each year, we're remaining with the incumbent carrier. Our goal is to obviously get the price down as much as we can, if it makes sense, but also focus on coverage, because my goal is to have the broadest coverage at the best price.
So Lynn, would you say that we're really normalizing back to what pricing was pre-COVID-19, or is there any lingering hangover effect from when the world turned upside down in 2020?
I mean, I definitely think we're back to 2018, 2019 rates. I don't think there's going to be much more movement down. I think you're going to start to see a flattening of pricing in the market. Unless there's significant claims on an account, I think you're still going to, at this time, get a few point reduction. If it's an easy placement, and I don't want to say anything's easy, if there's 5 quotes, you might get a larger reduction. It depends on the ability to secure alternate options.
Well, that's good news for risk managers' budgets. That's wonderful to hear. Are you seeing any particular areas that insurers are probing on renewal? And a couple of things that I've seen with clients are a few more questions about compliance or privacy, things of that nature.
Since COVID, I think those COVID questions have gone away, right? They're not so much focused on the COVID protocols in the office. I think there's probably a focus on working from home. I've seen a fluctuation in employee counts, a lot more than I'm used to seeing. At this moment, I don't see much focus. I think you'll start to see a focus on the AI usage with certain larger insureds, I think. But at this time, the smaller space, there's not so much focus on anything that's concerning.
Lynda, if I could just chime in for a minute on the
Please.
side, I think the biggest hangover we're seeing, for lack of a better term, is that it's very difficult to get some underwriters on the phone on Mondays and Fridays because they're working from home. So otherwise, it's business as usual. And I know Lynn gave you some perspective on the private side. I wanted, if it's all right, on the public side, What we're seeing is robust competition, especially on the excess placements, right? So as we discussed earlier, there are so many new entrants into the market, and we'll get into that because those new entrants are definitely going to be improving the buying process for the policyholder because, you know, supply and demand with all this excess capacity that's out there or extra new capacity that's out there, we're able to essentially use that capacity to affect healthy competition. Many of these new entrants are predominantly focused on excess D&O. Many of them came in with limited staff, limited claims abilities. They basically came in with strong capital, a decent management team. Many of them have phenomenal management teams, and they were really looking to just write excess because it's a one-page excess policy. But
if you're lucky.
Now, in order to survive in this business, considering the rate environment we're in, you have to be able to write primary or you're not going to last very long because there's so much competition and the rates that are out there have been diminished.
Yeah. And so I'm glad that you brought up new entrants, though, Rob, because one of the areas that Team Lowenstein and Team Mark are able to work very closely on is looking at the devil of the details of those new policy forms and the wording. Eric and I just did a podcast episode on a terrible decision out of the Third Circuit for an 8th layer excess carrier that had really bad language in that policy, and it voided $10 million of coverage. And so I know that you, Rob and Lynn, and your entire team know you got to have eyes on the actual words. And I always get a little prickly when I hear that we're going to place with a new entrant in the market. And it's so important to look at the actual wording of that policy, see that it really is a one-pager and not snuck in with some endorsements, right? We've all seen that movie before.
Yep.
It's what you're buying.
Exactly. What about at a high level in renewal for either public or private companies, ESG and DEI? The last couple of years, we've heard a lot about ESG. DEI initiatives have really come under attack in the wake of the Harvard decision. What are you seeing in terms of interest level on those two areas among underwriters right now?
Yeah, it's going to be much stronger on the public side just because of the size of the companies and the fact that there's an investment community looking at governance and things along those lines. Years ago, Lynda, a public company D&O renewal entailed us, the broker, putting the CFO in front of a bunch of underwriters, and he or she would speak of their financial condition and we'd get quotes. Right? Things have changed a lot.
Right.
Things have changed a lot over the last few years. And, so nowadays to get a real public company D&O renewal done the right way, you need to anticipate what's keeping the underwriters up at night. And it's not just the financial condition, but it's whether or not the company's compliant from a DE&I perspective, whether or not it's compliant from an ESG perspective, whether or not the company's compliant and has the right cyber liability practices and protocols. So the players on a deal have grown from the underwriters, the broker, and the CFO, but now we're adding the chief information officer. In many cases, we're adding the general counsel to talk about litigation or to talk about DE&I and ESG. And in some cases, we're even rolling out the director of human resources to talk about hiring practices and procedures, which has become so prevalent as of late.
Well, and I got to give the shameless plug again to you and your team because you do know how to prep clients for those kind of meetings. I always tell clients when you're going into a renewal or you're going into a meeting with a new potential suitor for a carrier, you don't get a second chance to make a first impression. And getting those executives on board and understanding how to speak the language of the underwriters is crucially important. And you guys certainly do that no better than any other brokers I've seen. Let's talk about other factors here in the D&O market right now. Are there any industries that you would characterize as particularly challenging to place insurance for right now?
I mean, yeah, I'll take that one. So basically, I'm like the boots on the ground. I'm busy placing coverage or securing quotes daily. So, I mean, I definitely think the banking industry is having a tough time. Healthcare, crypto, cannabis, the IPO space is still a challenge. But I also think one thing that's probably going to become a larger problem this year is any political risk. Any space that has exposure to politics is really going to be a challenge. And I think the majority of political action committees, for instance, are written on nonprofit forms, right? So these nonprofit forms tend to be broader, where they not only cover D&O claims, but they cover EPL claims as well. But their pricing is not in line with what private companies are paying, right? So they get one claim. It could be an EPL claim. They're paying $5,000 for their policy. Their claims are still $1 million. If it's a nasty claim, they're very expensive. So I think in that space, I think we're going to see an uptick in claim activity.
Well, but so Lynn, to that point, Are you telling me that those companies like a crypto or a cannabis are uninsurable? You can't get insurance for them? Or are we talking more about pricing and self-insured retentions?
Yeah, so we could get coverage for anything. I mean, there's a seat for every butt. It's just a question of how many players are in the space and whether or not the client is in a position to A, afford the coverage, and B, explain to their boards why they're spending so much money protecting themselves individually, right? And they have to explain that to their shareholders. So it really comes down to the industry. So for instance, the crypto industry, if you had asked me this question 2 years ago, I would say there's like one or two insurance companies that can potentially dabble in it. And now there's way more than a handful. And so that environment has loosened up a lot. As crypto and blockchain become more of a household name. Cannabis a couple of years ago was near impossible to get insurance for. And now we have multiple markets able to do it. But a company that's in the cannabis or crypto space is going to pay a lot more money for its D&O insurance than a manufacturing firm in Michigan. So that's the struggle we have, is just making sure that the clients understand, because some of these insurance companies, while they're able to write it, they're putting restrictive terms on.
Right. Yeah. Well, they're insurance companies, so they like to follow the money, but they're going to price the risk, right? I mean, those couple of industries are what some plaintiffs' lawyers look at as target-rich environments, we'll call it. All right. So how is the industry responding to the heightened regulatory environment that companies are facing right now? We're seeing a lot of activity, not only in SEC, FTC, that Washington's active. How is the D&O market responding to that?
Yeah, I think on the underwriting side, I mean, there's definitely certain classes of business that are being more underwritten more stringently. And they're definitely putting sublimits of coverage on certain coverages, antitrust, books and records, or derivative demand investigations. They're still sublimiting those coverages, and they know that it's a real exposure. So we definitely have a struggle to get those coverages up as high as we can get them on larger towers, let's say. The carriers are definitely pushing back on that, as they have done in the past, too.
Yeah, and on to what Lynn's saying, remember, a books and records demand is covered under the derivative investigative sublimit, right? So these are limits that are provided typically in a policy at no additional cost in a public D&O policy, and there's sublimits that are provided on a first dollar basis. And we're starting to see a real uptick in these claims. So I think the struggle is going to become where we used to be able to get let's just say the primary company is putting up a $5 million limit with a $1 million, or let's just say $500,000 derivative investigative sublimit that's picking up the books and records demand. We used to be able to get companies to throw in a 5x of 5 and stack a $250,000 derivative investigative sublimit over that at no additional cost. I think the excess market is still soft enough that we'll be able to get it done, but I think there's going to be a lot more underwriting around this free coverage that's being given.
Right. And policyholders need to know to ask. Once again, not all brokers are created equal. ARC certainly is attuned to this, but other brokers, not so much. And I'm going to wrap it up with another burning question. What's going on with AI, and how are D&O insurers and underwriters reacting to this? Are they paying attention to it? Seems like we can't open our Google News without hearing about the latest problem that AI is causing or disrupting in our society. How are D&O insurers thinking about this?
So I think this year is going to be the year that they're going to start to look at this definitely more closely. I think you may see a supplemental application in the works. I think they might start to really ask questions around it, because knowing how these EPL applications, and I'll speak about the EPL because I think it's going to be an issue on the employment practice side more right now than on the DO side. But I don't think these applications are equipped. The ones that are in the market that are being used with the clients, they're not equipped to ask the right questions at this time. So I think what we're going to see is a supplemental application designed, and it's going to be out there. And I think this is the year that the carriers are probably going to start to focus on the AI exposure of their clients.
Maybe they're using ChatGPT to formulate that application for us, Lynn. Who knows?
They are. They probably are.
And Lynn gave it to you kind of from a private company perspective. On the public company side, there is no renewal application. The underwriters rely on what's publicly disclosed with the SEC, 10K, 10Q, and the other public filings. So we all know that when a company makes a public disclosure about anything, the street reacts. And what a company discloses about its AI is being carefully looked at by underwriters now. If a company's just saying, oh yeah, we're very active in AI and we use it all the time, when they're kind of just, there's no detail behind it, there's no explanation. Underwriters are digging in on this and they want to see exactly how it's being used and what these companies are doing from a disclosure standpoint to make sure that what they are in fact doing is being adequately disclosed, so that obviously when something's not adequately disclosed, it could lead to litigation. So it's something that's being looked at definitely more closely on the public side. Just as Lynn said, on the private side, I think we can expect some more detailed underwriting questionnaires around the topic versus relying on public disclosures on the public side.
So that's a great point, Rob, because we can be certain that the plaintiff's bar is going to be carefully combing through public disclosures with a particular eye towards AI. Well, I really want to thank both of you, Rob and Lynn, for coming on today to share your knowledge. I think it's great news for policyholders that the market is soft right now and the prices are coming down and negotiability of terms is coming up. And we will certainly have you back to let us know how things are going later in the year, but really appreciate your time today and all of your insights and expertise. So thanks for joining us.
Thanks, Lynda.
Thank you, Lynda.
All right, we'll see everybody next time.
See you soon.
Thank you for listening to today's episode. Please subscribe to our podcast series at lowenstein.com/podcasts or find us on Amazon Music, Apple Podcasts, Audible, iHeartRadio, Spotify, SoundCloud, or YouTube. Lowenstein Sandler podcast series is presented by Lowenstein Sandler and cannot be copied or rebroadcast without consent. The information provided is intended for a general audience and is not legal advice or a substitute for the advice of counsel. Prior results do not guarantee a similar outcome. Content reflects the personal views and opinions of the participants. No attorney-client relationship is being created by this podcast, and all rights are reserved.